Remember when Bitcoin hit $69,000 in 2021, and everyone thought they'd be millionaires by now? 2 years later, many crypto investors are down 70% and wondering if they made a terrible mistake. But here's what most people miss. Crypto markets follow predictable cycles that smart investors can actually use to their advantage. In this video, I'll show you exactly what to expect in 2025 based on hard data, not the hype you're hearing everywhere else. The reality of crypto market cycles, why history keeps repeating. Have you ever wondered why crypto seems to follow the same boom and bust pattern every few years? It's not random at all. In fact, these cycles are surprisingly predictable once you know what to look for. Let's break down why so many crypto investors end up losing money and how you can avoid becoming another statistic in the next market cycle. Unlike traditional markets, cryptocurrency moves in extreme cycles that can make the stock market look like a lazy river ride. While the S&P 500 might consider a 20% drop a major bear market, Bitcoin has routinely experienced 80 to 90% drawdowns from its all-time highs. But here's what's fascinating. These dramatic swings follow remarkably consistent patterns. Most investors lose money in crypto for one simple reason. They buy high and sell low. They jump in when everyone's talking about Bitcoin at family gatherings and panic sell when prices crash. The data shows that retail investor inflows peak almost exactly at market tops, while institutions and long-term holders accumulate during the quiet periods when nobody's interested in crypto. This predictable behavior creates the perfect conditions for these recurring cycles. Let's break down the 4 key phases of cryptocurrency market cycles that have repeated since Bitcoin's early days. The first phase is accumulation, where prices stabilize after a major crash. This is when smart money quietly buys in while retail investors are still licking their wounds from the previous bubble. Bitcoin's accumulation phases typically last 12 to 18 months and often see price ranges that barely move for extended periods. The second phase is the uptrend or expansion phase. This is when prices start climbing steadily as positive news begins to attract new investors. You'll notice increasing media coverage, but not yet the mainstream mania. Historical data shows Bitcoin typically increases 5-10x from its accumulation range during this phase. For example, after the 2018 to 2019 accumulation around $3,000 to $4,000, Bitcoin steadily climbed to around $20,000 by late 2020. Next comes the peak or bubble phase, when prices go parabolic. This is when your Uber driver gives you crypto tips and social media is flooded with to-the-moon posts. Looking at previous cycles, this phase typically lasts just 1 to 3 months, but can see prices double or triple from already elevated levels. The December 2017 run to $20,000 and the April-May 2021 push to $64,000 both fit this pattern perfectly. Finally, there's the correction or bear phase, the painful period when euphoria turns to despair. Prices collapse, negative headlines dominate, and many declare crypto dead once again. These bear markets have consistently wiped out 80 to 90% of Bitcoin's value from peak to trough, taking 12 to 18 months to fully play out. What's truly remarkable is the timing consistency between these cycles. If we look at the data, Bitcoin has followed an almost clockwork-like pattern. The 2013 bull market peaked in December, followed by a bottom in January 2015, almost exactly 13 months later. The 2017 peak in December was followed by a bottom in December 2018, precisely 12 months later. And most recently, the November 2021 all-time high was followed by a bottom in November 2022, again, right around the 12-month mark. This isn't just coincidence. These price movements are tied to something much bigger than crypto itself. When we overlay Bitcoin's price action with central bank balance sheet expansions and contractions, the correlation becomes shockingly clear. Bitcoin bull markets have consistently lined up with periods of global liquidity expansion, when central banks are printing money aggressively. Take the 2020 to 2021 bull run as an example. The Federal Reserve expanded its balance sheet by over $4 trillion in response to the pandemic. During the same period, Bitcoin surged from $3,800 to $64,000. When the Fed began tightening in 2022, Bitcoin crashed back to around $15,500. This pattern has repeated across every major cycle. What's particularly interesting is that Bitcoin often leads traditional markets, both up and down. It topped out in November 2021, months before the stock market peaked in early 2022. Similarly, Bitcoin found its bottom in November 2022, while stocks didn't bottom until October 2023. This makes Bitcoin something of a liquidity canary in the coal mine. Even Bitcoin halvings, when the new supply of Bitcoin is cut in half approximately every 4 years, create predictable market effects. Historically, Bitcoin reaches a major peak roughly 12 to 18 months after each halving event. The 2016 halving was followed by the 2017 bull run peak. The 2020 halving preceded the 2021 peak, with the next halving scheduled for April 2024. This historical pattern would suggest a potential market peak in late 2025. Understanding these cycles gives you an enormous advantage when positioning for 2025. Most retail investors will do what they always do, pile in near the top and panic sell near the bottom. But you can take a different approach. By recognizing where we are in the cycle, you can make rational decisions instead of emotional ones. If these patterns hold, we could be looking at another major expansion phase beginning in 2024 and potentially peaking in 2025. But remember, while history rhymes, it doesn't repeat exactly. New factors like increased institutional adoption, regulatory changes, and technological developments could alter the timing or magnitude of these cycles. What's not likely to change is human psychology. Fear and greed drive these markets more than any technological development or adoption metric. When you see your friends who never cared about crypto suddenly becoming experts and bragging about their gains, that's a warning sign you're approaching a market top. Think of these cycles like seasons. Winter inevitably follows fall, but that doesn't mean we cancel all our plans because winter is coming. Instead, we prepare accordingly. Smart crypto investors don't try to avoid the cycles. They embrace them and position themselves to benefit from each phase. The liquidity factor. Why 2025 could be different this time. Those predictable crypto seasons might be due for some climate change. What if I told you the Federal Reserve and other central banks are painting themselves into a corner that could send Bitcoin's price action into uncharted territory? By 2025, record government debt levels might force monetary authorities to unleash unprecedented amounts of liquidity, and that money has to flow somewhere. We've watched how central bank policies and crypto markets dance together for years now, but the music is changing. Global liquidity isn't just some boring economic concept. It's literally the fuel that powers asset prices across the board. When central banks pump money into the system, that cash has to find a home, and increasingly, cryptocurrencies have become a destination for that excess liquidity. Let's talk about what's different this time around. The financial landscape heading into 2025 looks nothing like previous crypto cycles. Government debt burdens are reaching eye-watering levels, and fiscal deficits continue to balloon with seemingly no end in sight. This isn't just a temporary situation. It's a structural problem that's forcing central banks into a corner. Think about it this way. When governments spend more than they take in, someone has to buy all that debt. Historically, central banks have stepped in as the buyer of last resort when other buyers get nervous. The numbers suggest they'll need to do this on a massive scale in 2025, creating a potential rocket fuel situation for risk assets like crypto. What we're staring at is a pressure cooker of fiscal and monetary forces. Central bank balance sheets will likely need to expand significantly just to keep the system functioning. This isn't speculation, it's basic math. The amount of new government debt being created simply exceeds what private markets can realistically absorb without sending interest rates through the roof. This expansion of central bank balance sheets creates a very different environment than what we saw in previous crypto cycles. The sheer scale of liquidity that may flood markets in 2025 could make previous expansions look tiny by comparison. Remember, every dollar created needs to go somewhere, and assets with limited supply like Bitcoin tend to respond dramatically to these liquidity waves. But here's where things get really interesting: the institutional factor. Previous crypto cycles were primarily driven by retail investors and crypto enthusiasts. This time around, we have major financial institutions actually participating in the market. The approval of Bitcoin ETFs was a game changer that opened the floodgates for institutional money to flow into crypto markets. These aren't small players either. We're talking about the biggest names in finance who are now integrating digital assets into their offerings. They're not doing this for fun. They're responding to client demand and trying to capture market share in a growing asset class. This institutional adoption creates an entirely new source of demand that simply didn't exist in previous cycles. The most fascinating part? These institutions aren't just dipping their toes in the water anymore. They're building comprehensive digital asset infrastructure and services. When BlackRock and other financial giants start taking crypto seriously, it fundamentally changes the game. Their presence adds legitimacy, liquidity, and potentially stability to a market previously known for its wild volatility. Let's not forget about the regulatory picture, which might be the biggest wild card of all. The incoming administration appears to be taking a dramatically different approach to digital assets than we've seen previously. There are clear signals they plan to establish a more favorable and proactive regulatory environment, one that actually fosters innovation rather than stifling it. This isn't just about making crypto fans happy. It's about positioning the United States as a leader in a rapidly evolving financial landscape. The formation of a crypto advisory council and the establishment of clearer regulatory frameworks could unleash a wave of innovation and investment that would dramatically accelerate market development. Regulatory clarity is the missing piece that many traditional financial institutions have been waiting for. With the uncertainty removed, these giants can fully commit to the space without fear of running afoul of regulators. This could trigger a virtuous cycle of increased institutional participation, greater liquidity, and more stable markets. So what does all this mean for crypto market cycles? Will these new factors smooth out the boom and bust patterns we've seen in the past, or will they actually amplify them? The evidence suggests these factors won't eliminate cycles, but could potentially supercharge them. The combination of unprecedented central bank liquidity, growing institutional demand, and a favorable regulatory environment creates a potential perfect storm for price appreciation. However, markets rarely move in one direction forever, and the fundamental cyclical nature of financial markets remains a constant. What's particularly intriguing is how these factors interact with each other. Expanding central bank balance sheets provide the liquidity, regulatory clarity removes barriers to entry, and institutional adoption creates new channels for that liquidity to flow into crypto markets. It's a potentially explosive combination we haven't seen in previous market cycles. The approval of Bitcoin ETFs deserves special attention here. These investment vehicles create an entirely new on-ramp for capital to enter the crypto space. They allow traditional investors to gain exposure to Bitcoin without the technical challenges of self-custody or the regulatory uncertainties of crypto exchanges. This simplified access could dramatically increase the total addressable market for cryptocurrencies. As we look to 2025, it's important to separate the signal from the noise. While social media influencers will be screaming about price targets and token promotions, the smart money will be watching three key factors: global liquidity conditions, institutional adoption trends, and regulatory developments. These will be the true drivers of market direction. The question isn't whether crypto will continue to move in cycles. It almost certainly will. The question is whether those cycles will look similar to what we've seen before, or whether these new factors will create market conditions unlike anything in crypto's short history. Remember, markets are constantly evolving, and historical patterns only hold until they don't. The combination of factors we're seeing align for 2025 suggests we may be entering uncharted territory. While the seasonal patterns of crypto markets provide a useful framework, we need to adapt our understanding to account for these new variables. Lessons from the crypto graveyard: why most projects will fail. As we adapt to these new market variables, there's a darker pattern that remains stubbornly consistent year after year: the stunning failure rate of crypto projects. For every Bitcoin success story, there's a digital cemetery filled with thousands of forgotten tokens that took investor money to the grave. And understanding what sends projects to this crypto afterlife might be your most valuable investing skill in the volatile times ahead. Behind the flashy websites and revolutionary promises, over 2,000 cryptocurrencies have completely failed or been abandoned. That's not just a statistic. It represents billions in evaporated investor funds and countless shattered dreams of crypto riches. While everyone focuses on picking the next 100x winner, the smarter strategy might be learning how to avoid the losers first. The marketing versus reality gap in failed crypto projects is often staggering. Projects promise to revolutionize finance, disrupt global industries, or become the next Ethereum killer. But many lack the technical foundation, business model, or legitimate team to deliver even basic functionality. The hype machine churns at full speed while the development grinds to a halt behind the scenes. Let's look at some spectacular flameouts to understand what really causes crypto collapse. The Terra/Luna implosion in 2022 provides a perfect case study in algorithmic fragility. Despite a $40 billion market cap and widespread adoption, its fundamental design flaw, an algorithmic stablecoin mechanism that couldn't handle market volatility, led to one of crypto's largest wealth destructions in just a matter of days. What looked like innovative technology was actually a precarious house of cards that collapsed when market conditions changed. Then there's FTX, which seemed like the model of a successful crypto business until it catastrophically wasn't. Behind the marketing genius of Sam Bankman-Fried lurked mismanagement and alleged fraud that obliterated billions in customer funds. The collapse wasn't about technology failing, but about governance and compliance issues that were deliberately hidden from users and investors. These aren't isolated incidents. They represent patterns we see repeated across hundreds of failed projects. So what are the red flags that consistently predict crypto failures before they happen? First, watch out for unrealistic promises. When a project claims to solve all of blockchain's problems, infinite scalability, perfect security, and zero fees, it's usually compensating for a lack of genuine innovation. The blockchain trilemma, balancing security, decentralization, and scalability, exists for a reason, and any project claiming to have magically solved it deserves extra scrutiny. Anonymous teams should also raise immediate concerns. While Satoshi's anonymity worked for Bitcoin, today's projects need accountability. When founders won't reveal their identities or backgrounds, they're often hiding something. Whether it's a lack of qualifications or the intent to disappear with investor funds in a rug pull scam. Poor tokenomics is another classic warning sign. When team members and early investors hold massive token allocations with short or non-existent lockup periods, they're set up to dump on retail investors at the first price pump. Look for tokens where insiders control more than 50% of the supply. They're structured for extraction, not long-term growth. But beyond these obvious red flags, what metrics can actually help predict which projects will survive market corrections? Developer activity turns out to be one of the most reliable indicators. Projects with strong, consistent programming contributions tend to weather market storms better than those with flashy marketing but sparse code commits. You can monitor developer engagement across different blockchain platforms through sites that track GitHub activity. When development slows dramatically after the token launch or during market downturns, it often signals that the team was more interested in the initial fundraise than building something lasting. User adoption that extends beyond speculation is another crucial survival metric. Projects with genuine users solving real problems tend to persist even when token prices fall. If a project only has users when prices are rising, that's speculation, not utility. Look for consistent transaction counts, active addresses, and especially non-trading use cases to identify sustainable projects. Community health provides another window into project sustainability. Vibrant, technically engaged communities that discuss project improvements rather than just price action tend to signal projects with staying power. When community channels transform from technical discussions to price complaints, it often precedes collapse. Governance structure also plays a vital role in project longevity. Projects with transparent decision-making, gradually decentralizing control, and community input mechanisms have proven more adaptable to changing market conditions. When governance is an afterthought or concentrated in a small group, projects become brittle and unable to evolve. Regulatory compliance attitudes provide another survival indicator. Projects that proactively address regulatory concerns and build compliant systems from the ground up are positioned to thrive as regulations tighten globally. Those that take a move fast and break regulations approach typically find themselves cut off from critical financial infrastructure when regulators inevitably step in. It's also worth examining how projects responded to previous market downturns. Those that continued building and innovating during bear markets, rather than disappearing until prices recovered, demonstrate the resilience needed for long-term success. Bear markets are effectively stress tests that separate serious projects from opportunistic ones. Financial transparency deserves special attention. Projects that regularly disclose treasury management practices, burn through funds responsibly, and maintain runway for extended bear markets dramatically increase their survival odds. Many projects collapse simply because they mismanaged resources during bull markets and couldn't sustain operations when funding dried up. This survival framework explains why certain projects endured multiple crypto winters, while thousands of others vanished. Bitcoin and Ethereum have weathered numerous 80% plus drawdowns not just because they were first, but because they developed genuine utility, decentralized development communities, sustainable funding models, and regulatory adaptation strategies. Looking toward the next market correction, the projects positioned to survive will share common characteristics. They'll have solving genuine problems beyond speculation, strong developer communities actively improving the protocol, steady user adoption independent of token price, transparent governance mechanisms, and compliance-forward approaches to regulation. Beyond the hype, evaluating real blockchain innovation. Beneath the marketing hype and flashy white papers, a quiet revolution in blockchain utility is taking shape. While thousands of tokens crash to zero, the underlying technology is being adopted by major institutions at a record pace for uses that have nothing to do with trading or speculation. The question is, how do you distinguish genuine innovation from empty promises? In the crypto space, technical jargon has become the smoke and mirrors of choice. Projects toss around terms like proprietary consensus mechanisms and revolutionary layer, one solutions to sound innovative, but when you peel back the layers, many are just repackaging existing technologies with a shiny new token. It's like putting a Ferrari logo on a bicycle and claiming it can go 200 miles per hour. The first step in cutting through the noise is understanding what problems blockchain technology actually solves better than existing solutions. Most legitimate projects aren't trying to revolutionize entire industries overnight. They're focused on solving specific pain points where decentralization, transparency, and immutability offer genuine advantages. Smart contracts represent one of the most concrete blockchain innovations with proven utility. By 2025, we'll see these self-executing agreements eliminate countless inefficiencies in financial services. They're not just theoretical. They're already automating contractual agreements with precision and eliminating manual processes that typically cause delays and errors. Interoperability is another area where legitimate innovation is happening. The blockchain space initially developed as isolated islands. Bitcoin couldn't talk to Ethereum, which couldn't talk to Solana. Projects like Polkadot and Cosmos are creating the bridges between these islands, enabling different blockchain networks to communicate seamlessly. This isn't just technical jargon. It directly impacts scalability and opens up possibilities for cross-chain applications that weren't possible before. Privacy enhancements represent a third area of meaningful development. Zero-knowledge proofs and ZKS and ARKS sound like sci-fi terminology, but they solve a fundamental problem: how to verify information without revealing sensitive data. By 2025, these technologies will be crucial for maintaining user privacy while ensuring compliance with increasingly stringent data protection regulations. The tokenization of real-world assets is moving beyond concept into practical implementation. By 2025, we'll see significant growth in platforms that enable fractional ownership of traditionally illiquid assets like real estate and intellectual property. This isn't just another use case. It's a fundamental shift in how we think about asset ownership and transferability. DeFi is evolving beyond basic lending and borrowing. We're seeing the emergence of more sophisticated financial instruments like decentralized derivatives and algorithmic stablecoins. These aren't just copies of traditional finance. They're entirely new financial primitives that couldn't exist in centralized systems. But how do you evaluate whether a project is building something valuable? Start by asking these key questions. Does the project solve a problem that actually requires blockchain? Many blockchain solutions are addressing problems that could be solved more efficiently with a regular database. If decentralization, trustlessness, or censorship resistance isn't essential to solving the problem, blockchain might be overkill. Is there evidence of actual development? Check GitHub repositories for active commits and meaningful updates. Projects that are actually building something valuable tend to have consistent developer activity, rather than sporadic updates timed with token price movements? Can they explain their technology without relying on buzzwords? Legitimate projects can articulate exactly what they're building and why it matters in clear, straightforward language. If a white paper reads like a thesaurus had a fight with a technical dictionary, it's often hiding a lack of substance. Are they focused on solving real user problems or just pumping a token? Look for projects that prioritize user experience and solving genuine pain points rather than constantly discussing tokenomics and price potential. The most exciting innovations are happening at the intersection of blockchain and other emerging technologies. The integration with IoT is enhancing data security and authenticity, particularly in supply chain management. When blockchain ensures the transparency and traceability of data collected from IoT devices, it creates an unbroken chain of custody that wasn't possible before. The combination of AI and blockchain is opening up possibilities for decentralized AI systems that address critical issues like trust and data privacy. By 2025, we'll see platforms that enable more secure and efficient data sharing while protecting sensitive information, something centralized AI systems struggle with. Perhaps most impactful is how blockchain technology is facilitating financial inclusion for unbanked populations. By 2025, millions of people who lack access to traditional banking will gain entry to financial tools and resources through blockchain-based solutions that require nothing more than a smartphone. The development of DAOs, decentralized autonomous organizations, is transforming governance structures by allowing stakeholders to directly influence decisions through transparent voting mechanisms. While early DAOs were primarily focused on managing protocol treasuries, by 2025 we'll see these structures applied to more complex organizational challenges. The Blockchain as a Service, BaaS, model is making it significantly easier for businesses to adopt blockchain technology. Instead of managing complex infrastructure themselves, companies can deploy blockchain applications through service providers, dramatically lowering the barrier to entry for experimentation and innovation. Government adoption is another signal of blockchain's maturation. Regulatory frameworks that clarify legal and compliance issues are emerging globally. Rather than stifling innovation, these frameworks are encouraging responsible development and protecting consumers from fraud, necessary steps for any technology to achieve mainstream adoption. By 2025, the global fintech blockchain market is projected to reach $49.2 billion, driven by increasing demand for faster and cheaper financial services that operate globally. This isn't speculative hype. It's based on the concrete value blockchain provides in reducing friction in financial transactions. When evaluating potential blockchain investments, focus on this fundamental question. Does this project solve a genuine problem better than existing solutions? The projects positioned for sustainable growth aren't promising to change the world overnight. They're tackling portfolio reality check. How much crypto is too much? Now that we've learned how to spot genuine blockchain innovation, you're probably asking yourself the million-dollar question. Exactly how much of your hard-earned cash should you actually be putting into crypto? This isn't just academic. It's the difference between life-changing gains and portfolio-destroying losses. While crypto maximalists might tell you to go all in and traditional financial advisors often recommend zero exposure, the truth lies somewhere in the middle. And that sweet spot might be surprisingly smaller than you think. When it comes to crypto allocation, the biggest mistake investors make is letting emotion drive their decisions. During bull markets, FOMO pushes people to overallocate, while fear during crashes leads to panic selling. Instead of following these emotional extremes, let's look at what data-driven research actually tells us about sensible crypto exposure. BlackRock, the world's largest asset manager, has come to a surprising conclusion that might shock hardcore crypto enthusiasts. Their research indicates that a 2% Bitcoin allocation provides optimal diversification benefits without significantly increasing your portfolio's overall risk profile. That's right, just 2%, not 20% or 50%, like many crypto influencers might suggest. This modest allocation isn't about being conservative, it's about mathematical reality. Let's break down why this makes sense. According to 2 Sigma's research, Bitcoin's annualized volatility sits at approximately 81%. That's nearly 5 times more volatile than traditional stocks. When something is that volatile, even a small allocation can dramatically impact your overall portfolio performance. To put this in perspective, BlackRock's analysis shows that a typical 60-40 portfolio, 60% stocks, 40% bonds, can comfortably accommodate a 1 to 2% Bitcoin allocation without substantially increasing overall risk. However, push that allocation beyond 4%, and you're suddenly exposing yourself to potentially excessive risk due to crypto's wild price swings. JP Morgan takes a similar position, emphasizing that cryptocurrency investments should only be made as part of a larger diversified portfolio of stocks and bonds. Their research confirms that traditional asset allocation principles remain effective even for investors with crypto exposure, especially those with longer time horizons. But one size doesn't fit all. Your ideal crypto allocation should ultimately depend on your personal risk tolerance, investment timeline, and financial goals. Research indicates that high-risk investors might allocate up to 30% of their portfolios to cryptocurrency, though I'd personally approach that upper limit with extreme caution. More conservative investors typically limit their exposure to less than 5%, while moderate risk profiles generally suggest a maximum allocation of 20%. Remember, these aren't just arbitrary numbers. They're based on how crypto assets have actually behaved in real market conditions. During times of market stress, Bitcoin has shown a positive correlation with equities, which means it may not provide the diversification benefits traditionally expected from alternative assets. This correlation pattern further supports the case for modest allocation. Case studies tell an interesting story here. During the 2021 bull run, portfolios with higher crypto allocations significantly outperformed traditional portfolios, but they also experienced much sharper declines during subsequent market corrections. This boom and bust pattern highlights why position sizing is so crucial when dealing with highly volatile assets. Position sizing is one of the most powerful yet underrated risk management tools available to crypto investors. The concept is simple. Limit your exposure to any single asset based on its volatility and your personal risk tolerance. This prevents any single investment from tanking your entire portfolio if things go south. Another effective strategy is dollar cost averaging, investing a fixed amount at regular intervals regardless of price. This approach helps mitigate the impact of crypto's extreme price fluctuations over time. Rather than trying to time the market, which almost nobody can do consistently, you're spreading your purchases across different price points, potentially lowering your average cost basis. This leads us to a practical question. What might different allocation strategies look like for different investor types? Let's break it down. For conservative investors, low risk tolerance, preservation of capital is primary goal, 1 to 3% allocation to established cryptocurrencies like Bitcoin. Focus on dollar cost averaging with small, consistent purchases. Consider adding exposure only during significant market downturns. Potentially include stablecoins for lower risk yield opportunities. For moderate investors, balanced approach, willing to accept some volatility, 3 to 10% total crypto. Allocation. Core position in Bitcoin and Ethereum, 70 to 80% of crypto allocation. Smaller allocations to established altcoins with proven utility, 20 to 30%. Regular rebalancing to maintain target allocation percentages. For aggressive investors, high risk tolerance, seeking maximum growth, 10 to 20% total crypto allocation, rarely exceeding 20%. A diversified across multiple crypto sectors, DeFi, infrastructure, etc. Active management approach with defined entry and exit strategies. Still maintaining the majority of investments in traditional assets. Notice that even for aggressive investors, the recommended allocation typically doesn't exceed 20%, far less than what many crypto enthusiasts might suggest. This isn't because traditional finance doesn't get it. It's because mathematics and risk management principles don't change just because we're dealing with a new asset class. What's particularly interesting is how these allocations perform under different market scenarios. During the 2021 bull market, a portfolio with just a 5% Bitcoin allocation would have significantly outperformed a traditional 60-40 portfolio. Yet during the subsequent crash, that same modest allocation would have limited downside compared to more aggressive exposures. The relationship between risk and reward isn't linear in crypto. Going from a 5% to a 10% allocation doesn't just double your potential returns. It can more than double your risk exposure due to crypto's unique volatility profile. This non-linear risk relationship is why even small allocations can provide meaningful exposure. When determining your personal allocation, also consider your time horizon. Younger investors with decades until retirement might reasonably take on more crypto exposure than someone 5 years from retirement. The longer your time horizon, the more volatility you can potentially absorb. It's also worth considering your overall financial situation. Do you have an emergency fund? Are your high-interest debts paid off? Is your retirement account funded? Crypto should generally come after these financial fundamentals are addressed, not before. Digital Fort Knox, essential security measures for 2025. Now that your financial foundations are in place and you've calculated your ideal crypto allocation, there's a critical step most investors overlook: securing what you've built. In the crypto world, you're not just an investor, you're your own security team. With North Korean hackers stealing over $1.3 billion across 47 incidents in just the past year, the question isn't if someone will try to take your crypto, but how prepared you'll be when they do. The crypto security landscape has transformed dramatically. Back in 2021, we worried about simple phishing emails. Now in 2025, we're facing AI-powered scams that can mimic your friend's voice in a video call, asking you to send crypto to an emergency address. These aren't hypothetical threats. They're happening daily to investors just like you. Remember the Bybit exchange hack from February? Nearly $1.5 billion worth of Ethereum disappeared in a single incident. Even major exchanges with multi-million-dollar security budgets aren't immune. If they can't guarantee 100% protection, what chance do you have as an individual investor? Actually, you have a better chance than you might think if you follow the right protocols. The most successful crypto investors don't just pick the right coins, they build fortresses around their holdings. Let's break down exactly how to do that. First, understand the golden rule of crypto security. Never keep significant amounts on exchanges. Yes, it's convenient for trading, but exchanges are prime targets for hackers. Think of exchanges like your checking account. Keep only what you need for immediate transactions there. Everything else should be in your digital equivalent of a bank vault. This is where hardware wallets become essential. These physical devices store your private keys offline, completely isolated from internet-based threats. They're practically immune to remote hacking attempts because they never connect directly to the internet. When you want to make a transaction, the signing happens on the device itself, keeping your keys secure even if your computer is compromised. For Bitcoin specifically, cold storage is your best protection. The beauty of cold wallets is that they create an air gap between your keys and any online threats. Popular options include Ledger, Trezor, and Cold Card, with each offering different security features. For investments over $10,000, a hardware wallet isn't just recommended, it's absolutely necessary. But having a hardware wallet isn't enough. You need proper backup procedures. The 3-2-1 rule works well here. 3 copies of your recovery phrase on 2 different media types, with 1 copy stored in a physically separate location. Steel plates are ideal for physical backups since they survive fires and floods, unlike paper which degrades easily. For larger holdings, consider implementing a multi-signature setup. This requires multiple keys to authorize any transaction, similar to how a bank vault might need 2 separate keys to open. With a 2 of 3 multi-sig wallet, you could have 1 key on your hardware wallet, another in a secure deposit box, and a third with a trusted family member. Even if 1 key is compromised, your funds remain safe. Now, what about those DeFi tokens and NFTs? These require special attention because they often interact with smart contracts. Before connecting your wallet to any DeFi protocol, you should 1. Create a separate wallet specifically for DeFi interactions. 2. Only transfer the specific amount you plan to use. 3. Revoke contract approvals after you're done. 4. Regularly audit which contracts have permission to access your funds. Tools like Revoke.cash let you see and cancel any permission you've given to smart contracts, preventing future unauthorized access to your tokens. 2-factor authentication is another non-negotiable security layer. Enable 2FA everywhere, on exchanges, email accounts, and anywhere else connected to your crypto. But don't use SMS-based 2FA if possible. SIM swapping attacks are too common. Instead, use authenticator apps or, even better, hardware security keys like YubiKey. The security landscape for 2025 also includes new threats we're just beginning to understand. Quantum computing poses a theoretical risk to current cryptographic standards. While practical quantum computers capable of breaking Bitcoin's encryption don't exist yet, forward-thinking investors are already moving to quantum-resistant solutions as a precaution. I know what you're thinking. This all sounds complicated and time-consuming. And you're right. There's an inevitable trade-off between security and convenience in crypto. The more security layers you add, the less convenient accessing your funds becomes. But consider the alternative, losing everything because you prioritized convenience. That said, you can balance security and usability based on the amount you're protecting. For smaller amounts, under $1,000, a non-custodial mobile wallet with strong password and 2FA, regular backups of recovery phrases, basic phishing awareness. For medium investments, $1,000 to $10,000, hardware wallet for long-term holdings. Exchange accounts with advanced security features. Regular security audits of connected applications. For large investments, over $10,000, multi-signature setups. Hardware wallets kept in secure locations. Detailed security protocols written down for heirs. Regular penetration testing if technically feasible. Beyond technical measures, developing security awareness is crucial. Phishing remains one of the most successful attack vectors because it exploits human psychology rather than technical vulnerabilities. Never share your seed phrase with anyone. No legitimate service will ever ask for it. Be suspicious of unexpected communications, even from seeming friends or services you use. Verify requests through separate channels before taking action. Creating redundant systems is also important. What happens if you lose access to your authenticator app? Or if your hardware wallet is destroyed in a house fire? Every security measure should have a backup plan. Document these procedures and ensure trusted family members know how to access them in emergencies. Regular security audits should become part of your routine. At least quarterly, review your security setup. Have you revoked and used permissions? Updated firmware on your hardware wallets? Checked for suspicious account activity. These regular checkups can catch potential issues before they become catastrophic. The tax trap, avoiding costly crypto compliance mistakes. While you've secured your crypto assets from hackers, there's another predator lurking that's even more persistent, the tax authorities. And unlike hackers, they're completely legal in their pursuit of your digital gains. Let's face it, cryptocurrency taxation is a minefield that even experienced investors struggle to navigate. The IRS and tax agencies worldwide aren't waiting for the technology to mature before demanding their share. In fact, they're doubling down on enforcement and creating new reporting requirements specifically targeting crypto holders. What makes crypto taxation particularly challenging is that the rules weren't designed for digital assets. Tax authorities are applying traditional property tax principles to an entirely new asset class, creating confusion even among tax professionals. This disconnect has led countless investors into costly compliance mistakes they never saw coming. The IRS now requires reporting of all digital asset transactions on your tax forms. That innocent question on Form 1040 asking if you've received, sold, or exchanged digital assets. Answering incorrectly could trigger an audit or penalties. And it's not just individual. Returns. The same question now appears on business forms like 1041, 1065, 1120, and 1120S. Here's where things get tricky. Every single crypto transaction potentially creates a taxable event. Did you convert Bitcoin to Ethereum? Taxable event. Use Bitcoin to buy a coffee. Taxable event. Earn staking rewards. Yep, that's taxable too. Each one of these actions requires calculating your gain or loss and reporting it appropriately. The cost basis calculations alone can become a nightmare, especially if you've been trading frequently. Imagine trying to track the exact value of 50 different coins at the precise moments you acquired and disposed of them. Without proper record keeping, this becomes virtually impossible. Starting in 2026, the reporting net tightens even further with the introduction of Form 1099-DA. Centralized exchanges will be required to report transactions exceeding $10,000 directly to the IRS. This means the days of flying under the radar are coming to an end. The IRS will have transaction data to cross-reference against your tax return. Different crypto activities also trigger different types of tax treatment. Mining and staking rewards. Those are considered ordinary income at the fair market value when received. Later, when you sell those same coins, you'll pay capital gains tax on any appreciation since receipt. This double taxation effect catches many investors by surprise. The tax implications vary dramatically depending on how you interact with crypto. Short-term traders face ordinary income tax rates ranging from 10% to 37%, while long-term holders who keep assets for over a year benefit from preferential capital gains rates as low as 0% and maxing out at 20%. This dramatic difference can mean keeping thousands more dollars in your pocket with proper planning. DeFi activities create particularly complex tax situations. Lending your crypto through platforms like Aave or Compound generates interest income. Providing liquidity to decentralized exchanges may create multiple taxable events, from impermanent loss calculations to reward token taxation. And those governance tokens you received from participating in a protocol? Yes, those are taxable too, even if you never sold them. NFT transactions add another layer of complexity. Buying an NFT with ETH triggers capital gains tax on the ETH used. Creating and selling your own NFT is ordinary income. Flipping NFTs for profit? That could be considered dealer activity with even different tax treatment. So how do you avoid these tax traps while still participating in the crypto economy? Start with these practical strategies. First, adopt a long-term investment approach when possible. Holding assets for more than a year significantly reduces your tax burden through lower long-term capital gains rates. This single strategy can save you 10 to 20% on your tax bill compared to frequent trading. Second, implement tax loss harvesting strategically. Cryptocurrency's volatility creates regular opportunities to sell underperforming assets at a loss, offsetting gains from your winners. Just be careful to avoid wash sale rules by waiting at least 30 days before repurchasing the same or substantially identical assets. Third, consider using tax-advantaged accounts where possible. While directly holding crypto in IRAs has complications, some specialized retirement accounts now support digital asset investments, allowing tax-deferred or tax-free growth. Fourth, maintain meticulous records of every transaction. Each purchase, sale, transfer, and exchange needs documentation of dates, amounts, values in fiat currency, and the counterparties involved. Specialized crypto tax software can help track these details automatically by connecting to exchanges and wallets. Fifth, consider the tax implications before making transactions. That quick trade to capture a market movement might generate more tax liability than profit. Run the numbers before acting, especially for large transactions. Sixth, work with tax professionals who specialize in cryptocurrency. The field is evolving rapidly, and general accountants often lack the specialized knowledge needed to optimize your crypto tax strategy. For proper record keeping, utilize dedicated crypto tax software like CoinTracker, Coinly, or TaxBit. These tools can import transaction history from most exchanges and wallets, calculate your cost basis using methods like FIFO or specific identification, and generate tax forms ready for filing. The most common crypto tax mistake isn't malicious tax evasion. It's simply not understanding what constitutes a taxable event. Many investors are shocked to learn that wallet-to-wallet transfers, while not taxable themselves, must still be tracked to maintain accurate cost basis records. Another frequent pitfall is failing to account for hard forks and airdrops. When a blockchain splits or you receive free tokens, these often create immediate taxable income at fair market value, even if you never intended to receive them. Staking rewards present a timing challenge. Some investors report income when rewards are earned, while others argue taxation should occur only upon withdrawal when the rewards become fully accessible. The IRS hasn't provided definitive guidance, making this a gray area requiring careful documentation of your chosen approach. The 2025 Opportunity Map, where smart money is positioning. Beyond tax considerations lies an even bigger question for crypto investors in 2025. Where exactly should you be putting your money? The smart money isn't chasing yesterday's 100x tokens or following Twitter influencers. They're systematically targeting specific blockchain sectors poised for explosive growth based on technological and regulatory catalysts most retail investors completely overlook. While the average crypto investor is still debating which meme coin might pump next, institutional players are quietly positioning themselves in sectors they believe will dominate the next market cycle. This approach represents a fundamental difference in strategy, reactive versus proactive investing. And the gap between these two approaches is where real opportunity lies. Let's talk numbers that should make you sit up and take notice. The global market for fintech blockchain was valued at $3.4 billion in 2024, but it's projected to skyrocket to $49.2 billion by 2030. That's a jaw-dropping compound annual growth rate of 55.9%. This isn't random. It's a calculated move by institutions who recognize blockchain's transformative potential beyond simple currency speculation. So where exactly is this smart money flowing? Professional investors are focusing on three key areas that might not make for exciting TikTok videos, but represent the backbone of the coming crypto economy. First, they're heavily investing in DeFi 2.0 platforms. Not the first generation of protocols that struggled with security issues, but institutional-grade lending protocols offering competitive rates with robust security measures that traditional finance players can actually trust. Second, they're backing infrastructure projects that bridge traditional finance with blockchain capabilities. Rather than betting on which token might moon next week, they're investing in the picks and shovels of the crypto gold rush, the platforms and services that will be essential regardless of which individual cryptocurrencies ultimately succeed. Third, there's massive interest in real-world asset tokenization. Remember how the internet transformed music from physical CDs to digital files? The same transformation is happening with assets like real estate, commodities, and financial instruments. Only this time, blockchain is the enabling technology making these assets more liquid, accessible, and efficiently tradable. Geographic shifts are also creating massive opportunities that most retail investors miss entirely. The United States is expected to adopt a more favorable regulatory stance under the new administration, potentially positioning it as a global leader in blockchain innovation. Meanwhile, countries like Switzerland and Singapore aren't waiting. They're creating clear regulatory frameworks that balance investor protection with the freedom to innovate. This regulatory clarity is becoming a powerful magnet for crypto entrepreneurs and capital. This isn't just abstract theory. It's reflected in where venture capital is flowing right now. Current investment trends show growing interest in blockchain applications that enhance operational efficiency and transparency, particularly in supply chain management and digital identity verification. These aren't sexy casino-like gambles. They're foundational technologies solving real problems. So how can you, as an individual investor, adopt some of these institutional-grade strategies? First, stop thinking in terms of tokens and start thinking in terms of sectors. Instead of trying to pick the next 100x coin, allocate your portfolio across the key sectors attracting institutional investment. Consider creating a portfolio that includes a blend of established cryptocurrencies and emerging blockchain projects focused on specific use cases. This approach balances potential returns with manageable risk, exactly what professional investors do. For example, rather than throwing money at random DeFi tokens, research which protocols are attracting real institutional liquidity and building sustainable models. Pay close attention to regulatory developments, particularly in your jurisdiction. The anticipated regulatory clarity in the US and the implementation of the markets in crypto assets, MiCA, regulation in the EU will create winners and losers. Position yourself ahead of these changes rather than reacting to them after they occur. Think about your investment timeframe too. Institutional investors aren't day trading. They're positioning for multi-year trends. The integration of blockchain technology. With traditional finance isn't happening overnight, but when major financial institutions increasingly adopt digital asset offerings to capture market share and meet client demands, the growth curve can be exponential. Let's talk about something many crypto investors overlook: the importance of blockchain's integration with other emerging technologies. The intersection of blockchain with artificial intelligence, Internet of Things, and sustainable energy solutions is creating entirely new market categories. These convergence points often represent asymmetric investment opportunities where relatively small positions can yield outsized returns if you're early enough. Of course, we can't discuss 2025 opportunities without addressing Bitcoin's upcoming halving. While we've seen the historical impact of supply constraints, what's different this time is the institutional backdrop. Previous halving events occurred when Bitcoin was primarily a retail phenomenon. The 2024 halving will be the first to occur in an environment where major financial institutions have established significant positions through ETFs and direct holdings. This new dynamic creates a potentially explosive combination, decreasing new supply meeting substantially increased institutional demand. It's simple economics, but playing out on a global scale with implications that extend far beyond Bitcoin itself. What's perhaps most exciting about the 2025 opportunity landscape is how blockchain innovation is expanding beyond financial applications. Supply chain transparency, digital identity solutions, and data marketplace infrastructures are attracting significant capital because they solve fundamental business problems. These applications don't require users to understand blockchain. They simply deliver better, faster, and cheaper solutions to existing challenges. The integration of traditional finance with crypto is accelerating, creating what some analysts call pseudo-fi, centralized finance leveraging decentralized infrastructure. Major banks and financial institutions are no longer asking volatility management, turning crypto's biggest weakness into a strength. While financial institutions race to implement blockchain solutions, there's something about crypto that still keeps many potential investors awake at night: its wild price swings. But what if I told you that crypto's notorious volatility isn't just something to tolerate, but potentially your greatest source of profit? When most people see Bitcoin's 81% annualized volatility rate, they run for the hills. After all, that's nearly 5 times more volatile than traditional stocks. But professional traders see something different. They see opportunity in every price movement, whether up or down. Let's face it, volatility in crypto isn't going away anytime soon. Those 20% price swings that might seem terrifying are actually part of what makes this asset class so potentially lucrative. The key is learning how to harness this volatility rather than being paralyzed by it. One of the most powerful strategies used by professional traders is dynamic rebalancing. Unlike traditional rebalancing where you might adjust your portfolio once a quarter, dynamic rebalancing responds to market conditions in real time. When prices surge, you systematically take some profits, and when they drop, you strategically add to your position. This approach essentially forces you to buy low and sell high, without letting emotions dictate your decisions. Think about it this way. If you have a 5% crypto allocation that suddenly grows to 8% during a market surge, dynamic rebalancing would have you sell that extra 3% and move it to other assets. Then when crypto drops and your allocation falls to 3%, you'd buy back in to restore your target. You're essentially harvesting the volatility for profit. The beauty of this approach is that it works in all market conditions, not just during bull runs. In fact, some of the biggest opportunities come during bear markets when price swings are even more extreme. The more volatile the market, the more opportunities you have to capitalize on these movements. Strategic position sizing is another critical component of volatility management. Instead of asking, which coin will moon next, successful crypto investors ask, how much should I allocate to each position based on its risk profile? This means adjusting the size of your investment based not just on conviction, but on the specific volatility characteristics of each asset. For instance, you might allocate only 1% of your portfolio to a highly volatile new DeFi protocol, while putting 3 to 4% into more established cryptocurrencies. This way, even if that experimental position crashes 50%, your overall portfolio only takes a 0.5% hit. Uncomfortable, but not devastating. Options and derivatives have traditionally been tools for professional traders, but they're increasingly accessible to retail investors as well. Bitcoin futures and options can be powerful tools for managing volatility, allowing you to lock in prices or hedge your exposure without selling your underlying assets. For example, if you're worried about a potential market correction but don't want to sell your Bitcoin, you could purchase put options that increase in value if prices fall, offsetting some of your losses. Or if you're expecting volatility but aren't sure of the direction, strategies like straddles can profit from the movement itself, regardless of whether prices go up or down. What's fascinating is how the derivatives market in crypto has matured significantly. Just a few years ago, these tools were primitive and risky. Now, regulated exchanges offer sophisticated products that rival traditional finance options, opening new possibilities for managing and profiting from volatility. The psychological aspects of handling volatility might be the most challenging part of the equation. Let's be honest, watching your portfolio drop 20% in a week is emotionally taxing, no matter how experienced you are. This is where having a predefined strategy becomes crucial. Emotional decision-making leads to the two most common mistakes in crypto: panic selling during downturns and FOMO, buying during uptrends. By having clear rules for when to buy, sell, or hold, you remove much of the emotional component from your investing. One approach is to create a personal volatility playbook, a set of actions you'll take at different volatility thresholds. For example, if Bitcoin drops 10% in a day, perhaps that triggers a small buy. If it drops 20%, maybe you deploy a larger portion of your dry powder. The specific numbers will vary based on your risk tolerance, but having the plan in place before volatility strikes is what matters. There's also tremendous value in studying past crypto bear markets. Investors who maintained their discipline during previous downturns and focused on fundamentals rather than price action often emerged with substantially stronger positions when the market recovered. This historical perspective can provide the confidence needed to stick to your strategy when emotions are running high. Bear markets in particular offer unique opportunities for those prepared to capitalize on them. Beyond simply buying the dip, strategies like providing liquidity in DeFi protocols can generate significant yields during market downturns, as fewer participants typically means higher rewards for those willing to provide stability. Some protocols have offered double or even triple-digit APYs during bear market periods, rewards that simply aren't available in traditional finance. Another approach gaining popularity is targeting what traders call volatility compression periods, times when price movements become unusually subdued. These quiet periods often precede major moves, and positioning appropriately before volatility expands can lead to outsized returns when the market finally makes its move. The critical insight here is that volatility itself follows patterns. It's not random noise, but rather comes in predictable cycles of compression and expansion. Learning to recognize these patterns gives you a significant edge in positioning your portfolio ahead of major market moves. Your 2025 Crypto Action Plan. Practical steps for every risk level. Recognizing patterns is one thing, but turning that knowledge into an actual game plan, that's where the real challenge begins. The truth is, finding the right crypto strategy isn't about copying someone else's blueprint. It's about crafting an approach that aligns with your unique situation and tolerance for risk. And while BlackRock suggests a conservative 2% Bitcoin allocation for most investors, others might benefit from having up to 30% of their portfolio in crypto assets. Let's face it, those flashy YouTube thumbnails promising the ultimate crypto strategy aren't doing you any favors. Why? Because your financial situation, risk tolerance, and investment goals are uniquely yours. What works perfectly for a 25-year-old tech employee with decades until retirement looks completely different for someone nearing their golden years. So instead of giving you a one-size-fits-all approach that's destined to fail, I'm going to break down 3 distinct action plans based on your risk profile. Then we'll talk about how to adapt these frameworks as the market evolves through 2025. Ready to build your personalized crypto strategy? Let's get into it. For conservative investors, safety comes first. If you're in this category, you're likely approaching retirement, have significant financial responsibilities, or simply value stability over potential gains. Your crypto strategy should reflect this caution. Start with a maximum allocation of 5% of your overall portfolio, with BlackRock's recommended 2% serving as a solid baseline for most investors. Keep your investments focused primarily on Bitcoin, with perhaps a small position in Ethereum. Implement stringent security measures, including cold wallet storage for your crypto assets. A hardware wallet isn't just recommended here. It's essential, especially when you're dealing with significant amounts. Enable two-factor authentication everywhere, but avoid SMS-based verification that could leave you vulnerable to SIM swapping attacks. For tax efficiency, consider holding positions for over a year to qualify for those lower long-term capital gains rates. And speaking of taxes, maintaining meticulous records is absolutely crucial. Every transaction needs documentation, even wallet-to-wallet transfers that help you track your cost basis accurately. Quarterly rebalancing works well for conservative investors. If your crypto allocation grows beyond your target percentage, trim it back and redirect those profits to more traditional investments. And remember, dollar cost averaging is your friend here. By spreading your purchases over time, you'll avoid the psychological trauma of investing a lump sum right before a major correction. For moderate risk investors, you have more flexibility but still need structure. Your allocation can range between 5 to 20% of your portfolio, depending on your age and financial stability. Within that allocation, consider a 70-30th split between established cryptocurrencies and more speculative projects with solid fundamentals. Your security approach should include both hardware wallets and a clear backup strategy. Follow the 3-2-1 backup rule for your recovery phrases. 3 copies on 2 different media types with 1 copy stored in a separate location. For medium to large investments, steel plates that can survive fires and floods make excellent physical backups. Implement a more dynamic rebalancing schedule based on market movements rather than calendar dates. When your crypto allocation exceeds your target by 25%, like growing from 10% to 12.5% of your portfolio, that's your trigger to rebalance. This approach helps you naturally take profits during upswings while maintaining your desired risk profile. 4. Evaluating new opportunities. Develop a systematic framework. Examine the project's utility, team credentials, market demand, and regulatory compliance before investing. This structured approach helps you filter out hype from genuine innovation in the volatile crypto landscape. For aggressive investors willing to embrace higher risk for potential outsized returns, you might consider allocations up to 30% of your portfolio. However, this approach requires significantly more active management and security consciousness. Your portfolio might include early-stage projects, DeFi protocols, and emerging blockchain platforms alongside core holdings. Security becomes even more critical at this risk level. Consider implementing multi-signature wallet setups that require multiple keys to authorize transactions. Schedule monthly security audits to review permissions you've granted to smart contracts using tools like revoke.cash. Set specific percentage-based stop losses and take profit targets for each position to maintain discipline during extreme market movements. Regardless of your risk profile, certain practices are universal. Review your portfolio at least quarterly or after significant market movements to maintain your desired risk exposure. The crypto markets can move dramatically in short periods, making regular rebalancing essential for risk management. Implement dollar cost averaging to spread your purchases over time. This strategy helps mitigate the impact of volatility and removes the impossible task of trying to perfectly time the market. When Bitcoin experiences those 80% drawdowns that have historically occurred in every cycle, you'll be psychologically prepared and potentially in position to acquire assets at discounted prices. Education remains your best investment. The tax landscape for crypto is constantly evolving, with new reporting requirements emerging regularly. Starting in 2026, exchanges will be required to report transactions exceeding $10,000 directly to the IRS. Staying informed about these changes helps you avoid costly surprises when tax season arrives. Create decision triggers that prompt portfolio reassessment. These might include major regulatory announcements that change the legal status of certain assets, significant technological developments that could render some projects obsolete, macro shifts in monetary policy that might impact the broader crypto market, substantial changes in your personal financial situation that alter your risk capacity. Remember that tax loss harvesting can turn market downturns into tax advantages. By strategically selling underperforming assets, you can offset gains from winning investments while maintaining your overall market exposure. Just be sure to wait at least 30 days before repurchasing similar assets to avoid potential wash sale complications. What does all this mean for your 2025 crypto strategy? Start by honestly assessing your risk tolerance and investment timeline. Implement appropriate security measures based on your investment size, cold storage for significant amounts, two-factor authentication everywhere, and regular security audits. Determine your allocation based on your personal situation and risk profile, then use dollar cost averaging to build positions methodically. Finally, maintain discipline through market cycles by sticking to your rebalancing triggers and avoiding emotional decisions during extreme market movements. The biggest crypto question: is it really worth it? After all this talk about market cycles, security protocols, and tax considerations, we need to tackle the elephant in the room. Is cryptocurrency actually worth investing in at all? With the hype, volatility, and technical complexity, many still question whether crypto deserves a place in anyone's portfolio. Warren Buffett famously called Bitcoin rat poison squared, and many financial experts remain staunchly skeptical. This skepticism isn't without reason. Critics correctly point out that cryptocurrencies like Bitcoin lack an associated income stream. There are no dividends, no earnings reports, and no CEO working to improve profitability. For many traditional investors, this absence of intrinsic value makes crypto seem like a purely speculative gamble rather than a legitimate investment. But before dismissing crypto entirely, let's examine both sides of the argument honestly. The case against crypto isn't just about missing income streams. The extreme volatility can be stomach-churning even for experienced investors. The technical complexity creates barriers to entry and security risks. And yes, the space is still riddled with scams and questionable projects. Yet millions of individuals and increasingly major institutions continue to allocate capital to this asset class. Why? Because they see potential benefits that may outweigh these considerable risks. First, let's consider the technological angle. Blockchain technology extends far beyond just creating digital currencies. It's transforming how we handle information in supply chains, healthcare systems, and financial services. The technology's ability to provide transparency, security, and efficiency positions it as potentially revolutionary across multiple industries. By investing in well-chosen crypto assets, you're essentially getting early exposure to this technological shift. Think about investing in internet companies in the early 1990s. Many failed, but those who carefully selected the Amazons and Googles of that era saw extraordinary returns that compensated for numerous misses. The blockchain ecosystem today offers similar asymmetric return possibilities, where your downside is limited to what you invest, but your upside could be many multiples of that amount. The portfolio diversification benefits are also worth considering. When properly sized and managed, crypto assets can serve as a partial hedge during traditional market downturns. However, research shows that during periods of extreme market stress, crypto assets have increasingly correlated with mainstream financial markets, somewhat diminishing this diversification benefit. This is a crucial point that many crypto enthusiasts conveniently overlook. What about opportunity cost? If you avoid crypto entirely, what might you miss? Looking at historical performance, even a tiny allocation to Bitcoin over the past decade would have meaningfully boosted returns for otherwise traditional portfolios. Of course, past performance never guarantees future results, but it does illustrate the potential opportunity cost of zero exposure. But here's where things get interesting. The growing prominence of decentralized finance, DeFi, and the potential for blockchain to enable entirely new financial products suggest that cryptocurrencies may play an increasingly important role in the future financial landscape. These developments could enhance access to capital and financial inclusion globally in ways traditional systems haven't achieved. As the cryptocurrency market matures, regulatory frameworks are expected to become clearer, potentially enhancing institutional adoption and investor confidence. This evolving regulatory environment aims to balance innovation with consumer protection, which could lead to a more stable investment landscape for digital assets. But beyond all these market-level considerations, your personal situation matters tremendously in answering whether crypto is worth it for you specifically. Here are some personal factors to consider. Your technical aptitude. Are you comfortable learning about private keys, wallets, and security best practices? If not, are you willing to use more user-friendly but potentially less secure solutions? Your time horizon. Crypto investing requires a long-term perspective given the volatility. If you need your money back quickly, the extreme price swings make crypto particularly unsuitable. Your financial foundation. Do you have an emergency fund and other financial basics covered? Crypto should never come at the expense of fundamental financial security. Your risk tolerance. Not just what you say your risk tolerance is, but how you've actually behaved during previous market downturns. Many investors overestimate their ability to weather volatility. Your knowledge commitment. Are you willing to stay educated about evolving regulations, technology, and market dynamics? Crypto isn't a set-it-and-forget-it investment. The truth is, there's no universal answer to whether crypto is worth it. For some investors, a small allocation makes perfect sense as part of a diversified portfolio and aligned with their financial goals. For others, the complexity, volatility, and risk profile simply don't match their needs or preferences. If you do decide crypto has a place in your portfolio, focus on creating asymmetric opportunities, situations where your downside is clearly limited, but your upside potential is significant. This approach means never investing more than you can afford to lose completely, while still allocating enough to make a meaningful difference if things go well. The optimal crypto portfolio balances risk and reward through a disciplined framework that respects your overall financial goals. This might mean focusing primarily on established assets like Bitcoin and Ethereum, allocating a smaller percentage to carefully researched projects with strong fundamentals, and perhaps setting aside a tiny portion for higher risk, higher reward opportunities. It also means implementing appropriate security measures, understanding the tax implications, and consistently rebalancing to maintain your target allocation regardless of market conditions. Most importantly, it means having the emotional discipline to stick with your strategy when prices crater, and equally importantly, when they soar. As we wrap up our crypto reality check, I want to leave you with something crucial: the mindset that actually succeeds in this space. In our current year of 2025, the market won't care about your Twitter following or how many crypto YouTubers you watch. It'll reward those who approach it with discipline and emotional control. Industry leaders like Brian Armstrong of Coinbase understand this. He highlights that blockchain's true power isn't just in price speculation, but in its ability to move assets extremely quickly, peer-to-peer, and get them, without borders, all over the world. This transformative potential is what serious investors focus on beyond the price charts. The biggest crypto gains don't come from frantically jumping between trending coins. They come from developing a strategy you can stick with through entire market cycles, both exhilarating ups and gut-wrenching downs. Whether you ultimately decide crypto deserves 1% of your portfolio or none at all, make that choice based on genuine understanding rather than fear or greed. That's the only approach that survives long